AI creates a tale of two economies. Artificial intelligence has shifted from a promising technology to a macroeconomic force. Massive capital spending on data centers, chips, and software is inflating headline GDP figures, while the broader economy shows signs of strain. The job market appears softer amid concentrated tech layoffs. Profits and stock gains concentrate among a few players, trade balances tilt, and productivity promises remain mostly future tense. This creates a tale of two economies, an AI-fueled boom in infrastructure and a more sluggish backdrop elsewhere. GDP investment surge props up growth, but net domestic gains are more modest. In the first quarter of 2026, United States GDP grew at a 2.0% annualized rate. Business investment, especially in tech equipment, plus 43%, software, plus 23%, and data center structures, plus 22%, drove much of the expansion. Software data centers alone contributed a record 1.34 percentage points, surpassing the dot-com peak in 1999 and marking the strongest multi-quarter average on record. AI-related categories, information processing equipment, software, data centers, and related R&D have powered roughly 39% of recent growth. Morgan Stanley projects the top hyperscalers, Amazon, Alphabet, Meta, Microsoft, and Oracle, will spend around $805 billion on capex in 2026, nearly double 2025 levels, rising to $1.1 trillion in 2027, about 3.3% of United States GDP. Some estimates suggest AI investment could add 1.4 to 2.5 percentage points to GDP growth this year, with even higher figures for 2027. Yet the picture is nuanced. Much hardware is imported, so net domestic contributions shrink after subtracting trade effects, often to 0.4 pp or less in a given quarter. Goldman Sachs and others have described the net GDP boost from hundreds of billions in 2025 spending as close to zero in some analyses, due to imports and potential crowding out. Without AI capex, broader business investment would have been flat or negative in recent periods. Comparison to the dot-com era reveals both striking parallels and important differences. In the late 1990s, massive investment in internet infrastructure, fiber optics, servers, and broadband totaled over $800 billion cumulatively and significantly boosted GDP figures. Much like today, this created a perception of strong growth that masks softer underlying trends in the non-tech economy, with delayed broad productivity payoffs arriving only in the mid-negative 2000s after the bust. Today's AI boom amplifies several aspects of that dynamic, but on a faster and larger scale. Lewis Fed analysis shows AI-related investment categories contributed 0.97 percentage points to real GDP growth in the first 9 months of 2025, 39% of total growth, compared to 0.81 percentage points, 28% share. At the 2000 dot-com peak, software's contribution stands out sharply, 0.35 pp today versus just 0.11 pp in 2000. Data centers, a category not distinctly tracked then, add further lift. As a share of GDP, however, AI infrastructure spending remains below historical tech boom peaks, under 1% versus 1.5 to 2% or higher during the dot-com telecom surge or earlier episodes, like electrification and railroads. Scale and concentration differ markedly. Dot-com era infrastructure spending was spread over years and involved many speculative players. AI hyperscaler capex is more concentrated among a handful of cash-rich giants, and is accelerating rapidly. Projected annual figures already rival or exceed the entire cumulative negative 1990s telecom build-out in some estimates, with analysts occasionally describing the investment wave as many times larger in intensity. This concentration sustains tech valuations and profits today, but also heightens systemic risks if returns disappoint. Fundamentals provide a stronger base. Unlike the late 1990s, when many dot-com companies generated little to no revenue or profits, with only about 7% of listed tech firms profitable at the peak, today's leading AI players boast substantial cash flows, enterprise revenue, and proven business models. Earnings growth has driven a larger share of recent tech returns, compared to pure multiple expansion in the dot-com era. This suggests any correction would likely occur from a higher foundation, with more durable companies surviving. Productivity and payoff timelines echo each other with a twist. The dot-com boom laid essential groundwork, cheaper computing, connectivity for the 2000s productivity surge, but immediate measured gains were limited before the 2000 to 2002 bust. AI shows even less broad productivity impact so far. Net GDP contributions remain modest after imports, but early signals of enterprise adoption and efficiency gains in exposed sectors appear stronger than at comparable dot-com stages. Long-term forecasts point to a potential productivity supercycle with 0.5 to 1+ percentage point annual boost possible, adding trillions globally by 2030 to 2035 if adoption scales beyond infrastructure. Bubble risks persist in both elevated valuations, market concentration, technicians' profit and index weight at highs, and high. Yet the AI cycle benefits from institutional dominance, corporate funding rather than speculative retail debt frenzy, and tangible early applications. A 2026 pop on the scale of 2000 seems less likely. Instead, analysts anticipate possible digestion or selective shakeouts amid continued growth. Australia is a case study in productivity urgency. Australia, the world's third largest destination for AI investment after the United States and China, highlights the stakes. Labor productivity has stagnated near 2019 levels for years, with multi-factor productivity, MFP, declining 0.5% in 2024-2025. The Reserve Bank of Australia has lowered its medium-term labor productivity assumption to just 0.7% annually. A data center pipeline approaching 6 gigawatts, 150 billion Australian dollars, by 2030, could more than triple capacity and add 80 billion Australian dollars annually to GDP plus 100,000 jobs. Commonwealth Bank of Australia deems a sustained 0.8 to 1.0 percentage point annual productivity uplift from AI credible, potentially lifting potential GDP growth from 2.1% toward 3%. The Productivity Commission sees more modest MFP gains, 0.23 pp annually over a decade, still equating to meaningful cumulative lifts of 4.3% in labor productivity and 116 billion Australian dollars in GDP. In productivity lagging advanced economies, AI infrastructure offers a rare pathway to revive living standards without overheating jobs. Modest headline adds mass concentrated pain and hiring caution. Overall, United States payroll growth continues, but AI is distorting the picture. Tech and white-collar sectors face meaningful pressure. AI has been cited in over 85,000 tech job cuts in early 2026, with the information sector shedding jobs for extended periods. Tech unemployment has edged higher, and young software developers have seen notable employment declines. Firms explicitly link efficiency gains from AI to workforce reductions, even as they pour billions into infrastructure. Goldman Sachs estimates hundreds of millions of global full-time jobs face exposure to AI automation over the coming decade, with 40% of jobs in advanced economies potentially affected. Hiring in high AI substitutability roles has slowed significantly since generative AI's launch. This echoes dot-com dynamics, boom time hiring followed by adjustment, but with a twist. Displacement is occurring during the investment surge itself, via real-time automation rather than post-bubble consolidation. Counterpoints exist. High AI exposure industries have posted stronger job and wage growth in recent data, and new roles in AI engineering and implementation are emerging. Yet the asymmetry, visible cuts in tech versus diffuse gains elsewhere, fuels caution and pessimism. Wages and income, skill premiums rise amid uneven gains. AI skills command significant premiums, reportedly 56% in some analyses, with wages in exposed sectors rising faster and revenue per employee showing outsized growth. Consumer surplus from generative tools has also expanded rapidly. However, benefits concentrate among high-skill workers and leading firms. Lower complementarity roles face employment risks, and displaced workers historically experience sustained wage pressure and higher re-unemployment spells. In Australia, AI-driven productivity could help address stagnant real incomes. Elsewhere, polarization risks widening gaps. The bottom line: AI capex on the scale of $600 to $800 plus billion annually from hyperskillers is delivering visible economic lift today, powering GDP, boosting supplier nations like Taiwan and South Korea, and sustaining tech valuations. Yet net domestic productivity and broad-based gains lag, much as in the dot-com era, creating distortions that make the economy appear stronger or weaker than underlying trends suggest. The outlook hinges on scaling adoption beyond infrastructure. If AI delivers the productivity acceleration many forecast, 0.5 to 1 plus PP annually, it could power a new growth era, especially urgent in places like Australia. Risks include overinvestment bubbles, energy constraints, import dependence, and social strains from uneven disruption. As of mid-2026, the boom is real, the distortions pronounced, and the ultimate payoff still unfolding. Policymakers, businesses, and workers would do well to prepare for both the upside potential and the transitional frictions.